So, what if I told you that you don't need any fancy Wall Street degree or any MBA to pick stock as good as, if not better, but as good as the Wall Street experts? Well, this is not what I'm saying, but this is a principle that Peter Lynch believed in. So, if you don't know Peter Lynch, he is one of the legendary investors uh, who has ever lived, and he was the portfolio manager for the Fidelity Magellan Fund. And during his tenure of managing that fund, he returned 29.2% return year on year, which is exceptional performance when it's come to the mutual fund industry. So in this video, let's discuss what Peter Lynch says about how the common people like you and me have an edge over the Wall Street experts to pick the stocks. Okay, so the first core principle that Peter Lynch talks about is that the retail investors or the common people tend to overestimate the ability of the Wall Street experts or the Wall Street analysts when it's come to stock picking. So here are three main reasons or three important reasons why we should ignore this kind of belief. First is that the Wall Street experts don't have any crystal ball. Like they don't have any supernatural power to predict the stocks or the economy or the stock markets in general. Second is that you have your unique advantage as a retail investors because when it comes to picking up stocks, it's not about uh, having some kind of thing, but it is to invest in good companies. And you, as a retail investors, do have an edge over the market experts because you, in your daily life, come across a lot of stock opportunities or business that are local or are in a nascent stage and that have not yet reached the institution level investments. So in these kind of businesses, retail investors do have an edge over the market experts or market analysts. And third point is that when we talk about the institutional portfolio managers, they do have some constraints when they are managing portfolio. Like they have to show year on year or quarter to quarter growth of their fund. They have to explain to their fellow managers, colleagues about why they are picking up certain stock, and that too in detail, whatever the research that they have done. But towards retail investors, there is no such restrictions. They can put uh, they can put whatever amount of money they want in whatever amount of uh, in whichever company stock or stock they want to. This can be advantageous and disadvantageous to both because there are high chances that you can actually make a lot of money or you can actually lose a lot of money as well. But when you diversify, you actually lose those gains. So just think about, you pick up a good business and you believe that that business is going to do good in the upcoming years, and you find out this company off the radar. You didn't get to know this company from any institutional newsletter, newspaper, or maybe your stockbroker recommending that company to you, but you invested in company because you actually like the product or you see the growth in your local area. So this is the advantage that the retail investors have, and that's how you invest in a stock, seeing the fundamental growth, the product, and this is the fundamental analysis that the Wall Street experts actually do, and they get paid for it. And the retail investors do have an edge because you can pick those stocks at a very nascent stage, and when you put a lot of money in that particular company, you can actually have some big gains. Okay, so this was the first point. Second point that he actually focuses on is the prediction of the stock markets. So if we talk about the stock markets, it is just a marketplace for stocks. or the or and stocks in general are the part of businesses that do trade on these stock exchanges. So, what we should be focusing on is to identify good businesses and invest in those good businesses rather than predicting the stock market or the economy in general. And talking about the stock markets, we should be investing in them in the long term, because the short term fluctuations can be because of certain panics or certain things that are out of our control. But if we look at the stock markets in the long term, let's say 10 years period, we will see that the good businesses and their stocks do perform good in the long run. Short-term fluctuations cannot be predicted, and many people have tried. There are many things to predict the short-term fluctuations, but the accuracy for those predictions are very low as compared to the long-term growth of the stocks and their businesses. So retail investors, what they should be focused on is finding good businesses and buying their stock and holding them for an extended period. Also, doing the fundamental research on a regular basis just to see if the fundamentals are not being detroited or they are not going off track. So that is the time when you should be selling off your stock and booking and book some gains. And third is that the stock market, understanding stock market is is crucial, because you can make good losses in the market, you can make good losses in the markets. So there are two aspects, and it's not the market or the business, but it's the investors uh, who has the actual power to make money or lose money. So, like, to summarize everything, the main 3 points that the Peter Lynch focuses on is: number one, retail investors do have an edge over the institution or market experts because of their local knowledge of businesses, their uh, fundamental analysis of the products, the growth of the business. Number one. Number two is to actually think of stock as buying a business. Buying a good business and undervalued business will give you good returns in the long term. Not We are not talking about the short term fluctuation or predicting the markets, but to buy good stocks at a good price and holding them for long. And third point is to understand that the stock market is not for everybody, and you can make a lot of money, you can lose a lot of money in the markets, but in the end it's not the markets, it's not the stocks, but it's the investors who are going to make money or who are going to lose money. The investors are the main reason, and this includes finding good businesses, doing fundamental research, and keep doing the research just to know when to exit the position. So these were the main 3 points that I wanted to share about what the Peter Lynch has talked about in his book One Upon Wall Street in the first section. So in the next video, we'll be talking about his philosophy, how he used to pick some multi-bagger stocks. So I've just finished up reading this book, and I thought maybe I would make some videos about my learnings on this book. So second, we'll be talking about how he was able to generate so much return for his investors, which is like 29% year on year, which is quite exceptional. What was his philosophy, how he used to conduct his fundamental research, and how he used to pick up uh, businesses to invest in. So what one point that he recently or I have recently discussed is to have an edge as in retail investors or a local consumer of certain businesses. So let's so that's it for today. Let's discuss about picking up stocks in the next video.